Something historic happened in December of 2023 for the stock market. For the first time in its history, the amount of money investors have that is passively managed surpassed the amount that is actively managed. This trend is something that the investment industry has referred to as the single most transformational change in behavior over the past several decades. And I think this is for the better. It's been well documented that fund managers' performance have gotten worse as the years have gone on. As we can see in this chart here, in any given year, anywhere from 40 to 80% of active fund managers will underperform a benchmark index. And if we stretch this out over 10 years, you're looking at over 90% of active fund managers that have underperformed. BlackRock, Vanguard, and State Street now collectively control about 20% of the ownership of S&P 500 companies. And roughly one third of the S&P 500 now comes from just 7 companies, the Magnificent Seven. All these changes have happened because of this massive shift in investor behavior. So, this presents a new set of challenges to us investors because this has fundamentally changed how the stock market works. And if this trend continues, it will have some serious implications for investors going forward. In today's market, more investment dollars flow into companies based on their inclusion in a given index rather than anything to do with a fundamental analysis of the underlying business. And so, with this change, there have been some stark warnings from famous investors proclaiming that we're now in a passive investing bubble. A recent memo that was published by Howard Marks called On Bubble Watch discussed this emergence of the Magnificent Seven, and he argued that the way these companies are being valued right now assumes that they will remain as dominant as they are now for decades to come. Even though historically this hasn't been true, the biggest companies in the world 25 years ago look very different than the biggest ones today, with a few exceptions. And he also said that part of what makes him worried about the current market is this rise of passive investing, where stocks are bought indiscriminately based on their inclusion in a given index. Michael Burry has also been pretty outspoken about this, saying that this rise of passive investing has removed price discovery from the market. And price discovery is this idea that each company's stock has some amount of inherent value, and investors should be buying and selling it based on what they think the price of the stock is in relation to that inherent value. And passive investing distorts this whole dynamic. As of the beginning of 2025, the Magnificent Seven stocks make up roughly a third of the value of the S&P 500. The largest 7 companies making up that big of a share of the index is truly unprecedented. The highest it's been previously was roughly 22% in 2000 at the height of the internet bubble, and before that it was 24% in the early 1980s. So this level of dominance from just a few companies in the index has raised some concerns, and not just concerns from high-level investors whose job it is to try and outperform an index, but even just regular investors like you and I. Are our portfolios truly diversified if a third of our money is in just 7 different companies that are all kind of in the same sector of the market? And are these companies' stock prices being continually inflated due to their inclusion in the index and them receiving the lion's share of the money that people passively invest? So in this video, I want to explore if this is actually something that is worth paying attention to and something we should be concerned about as investors, or are all these alarm bells not really worth listening to? So without further ado, let's dive right in. So in the 1970s, Jack Bogle launched the first ever passive index fund called the Vanguard 500 Fund. And the goal of this fund was simple: offer investors a super low cost investment vehicle that just tracks the index and doesn't rely on analyzing individual companies to decide what's worth buying and selling. Jack Bogle also believed that since most active managers failed to outperform the index, investors should just stay invested in the index, especially after accounting for fees. They'd be far better off just investing passively. And I know that this sounds obvious today, but back in the 1970s, this was not the conventional wisdom. Many investors believed that finding a good active manager and paying higher fees for that better performance was going to be worth it in the long run, but over time, this belief has dissipated. Now, there's many reasons for this, but the simplest one is that active investing has just become more difficult to do successfully. Before the internet age, there was considerable reward to be had by gathering information that other investors weren't looking at and analyzing that information. But in today's world of algorithmic trading and instant access to information, it's much harder to get an advantage. And US stocks in particular have seen a steady increase in capital flowing into them, which is one of the reasons why US stocks have become increasingly expensive over the years. Right now, the Shiller PE ratio for the S&P 500 index sits in the high 30s, which historically speaking is very high and puts US stocks in overvalued territory. Now, the reason you should care about this particular metric is because there's very well supported research that shows that the higher the Shiller PE ratio is, the lower future returns tend to be for that index. A Shiller PE of 38x would historically indicate 0 to 4% annual returns over the next 15-year period. Now, with that being said, I don't want your takeaway from that to be that you should now go and sell all of your stocks because the market is clearly overvalued. Timing the market is essentially impossible to do, and even though right now you have all these famous investors making these bold claims about a passive investing bubble, even those people can't properly time the market. For example, back in 1996, the Shiller PE ratio was hovering around 25x, and Alan Greenspan had his famous irrational exuberant speech, which at the time many investors interpreted as him saying markets had become too expensive. But the market kept rising for 4 more years after this before finally crashing in 2000. And as we can see, the level it ended up dropping to was still higher than what the value was a few years ago back in 1996. And you can even look more recently. In 2017, the Shiller PE was around 30x, which was still historically high, but the S&P 500 has still more than doubled in value since then, while also paying dividends along the way. So the point is that even if you believe that the market will crash, and even if you end up being right about it, if you can't get the timing right, then it's not really a profitable strategy. Now, what I think is the real biggest risk is whether or not passive investing has caused mega cap stocks like the Magnificent Seven to become overvalued. Since these companies now represent a third of the index, this does present a risk to investors. This is something that's starting to get studied more and more because it is such a prominent issue for investors right now. One study that was done was called Passive Investing and the Rise of Mega Firms, and it found two interesting things. One was that passive investing disproportionately raises the stock price of the economy's biggest firms, and that the effects are strong enough that it causes the overall market to rise, even when the fund flows are entirely due to investors switching from actively managed funds to passively managed funds. And then another study that was done by Apollo had a similar conclusion that when active investors became passive, large cap stocks benefited disproportionately. Basically, how this works in simple terms is that you can classify all investors as either two types, active or passive. And the key difference between them is that active investors will go and analyze every company within an index, and they'll be either long or short those companies based on their analysis, whereas passive investors are just long every company regardless of any fundamental indicators. So when you have more investors that move from being active investors to now being passive investors, you're also going to have less investors that are short certain companies. Now, when a stock rises in price, investors who are short that particular stock may be forced to cover their positions where they have to buy back the stock in order to close out their short position. So that additional buying of the stock causes it to go up even more because it's more demand for the security. So with fewer investors who are shorting stocks, it becomes easier for those stock prices to go up even higher. And since large cap stocks already receive majority of the inflows that come from passive investors, this effect is more pronounced in larger and mega cap stocks. So essentially what you have is this self-reinforcing cycle where more passive flows means more buying, so short sellers are forced to close their short positions, which means stocks rise even further and even fewer people are short stocks, which means more upward momentum. And in a world now where 60% of US equity funds are classified as passive, which is up from 30% back in 2012, this effect is much more pronounced. Now, one of the most comprehensive studies done on passive investing was done by the Federal Reserve back in 2018, and it also focused on topics like volatility and stock valuations. And what it found was that the passive shift has amplified market volatility, where stocks with higher rates of ETF inclusion displayed higher volatility than otherwise similar securities, which also aligns with what other research on this topic has shown. However, the impacts on the valuations of stocks that get added to an index and stay a part of an index is still unclear. It is well documented that when a company gets added to an index, its price jumps because more people have to buy that stock because those people are tracking that particular index. Now, the study does say that it is possible that when stocks get added to an index that those particular stocks become overvalued because of their inclusion in the index, whereas other companies that make up a smaller part of the index and aren't receiving the same amount of fund flows are comparatively undervalued. But that's more so limited to a case by case basis where you may have one stock that's overvalued and one stock that's undervalued. It doesn't necessarily mean that the market overall is overvalued and is due to crash at some point. And this study also talked about the possibility that passive investing has this self correcting mechanism inherent to it, where if passive investing does cause there to be mispricings in the market where certain stocks are overvalued, this will make active strategies that can take advantage of these mispricings more profitable, which will make them more popular once again and kind of balance things out, which is a similar conclusion that a research paper that was published by AQR had, basically arguing that although passive investing has become more prominent, it's not yet at a level that would suggest markets are mispricing or overvaluing stocks. But if this were to happen, it would create opportunities for active managers to take advantage of these mispricings, which would lead to better performance and thus more flows back into actively managed funds. So I think now what we have to do as investors is acknowledge that this rise of passive investing has changed the stock market. We're probably going to have to deal with higher volatility in markets going forward as this trend continues. But like the research suggested, if actively managing your portfolio is your thing, then you should be able to exploit that volatility to your advantage when it occurs. And also, fund flows matter a lot now, but more so when it comes to understanding individual stocks within the index. It's unlikely that the index overall is overvalued simply because of passive investing, and fundamental forces still play a big role in the market. So let me know what you guys think in the comment section. I'd love to get your thoughts on what you think of this topic, but I hope you did enjoy this video. If you did, then please leave a like. And if you're new to my channel, I'd appreciate it if you would consider subscribing, and I'll see you guys in the next video.